fear I pour you spit, I pour spit for your face. Because if I not pour spit for your face today, tomorrow you go still pour me spit.
Hello guys and welcome back to the Cedi investor. I know you know what you're going to talk about today. Bank, they just released their Q3 statement and we are going to go over the performance or lack of performance. The company also recently announced its rights issue and basically dilution of the company. So we are going to go over that as well and I'll give you my overall thoughts on the company. Let's get into it. Starting off with the income statement, we can see this is very similar to the report we had in Q2 where everything in the business is quite still not good. We can see that interest income went down 693 to 597 million. Net fees and commission income also went down from 157 to 137. Revenue, not as good. They did make some revenue from net trading income, going up 64 to 89. So looking at their revenue for 2025, it was 38 million compared to 540 million for last year. So basically less compared to last year. However, looking at operating income, it did increase slightly, going to 564 from 556, and that's because of other income, but they didn't break it down, so I don't know where the other income came from. After expenditures, they ended off the year with a profit before tax of 354, slightly above what they made last year, 343. But we can see again net impairment gain on financial instruments being the key thing throughout this whole quarterly report. We saw it in the Q2 report, we saw it in the Q1 report as well. Basically money that was set aside, probably they set aside way more than what they needed to cover the losses on DDEP and also defaulting on loans. They set aside a lot of money and now they are able to take up some of that money that they set aside, bring it back to support their income statement, and that's what we can see helped cushion the profits before tax. Profits for the period, because of taxation, ended up being slightly less compared to that of last year. But we can see that the earnings per share, this is the key thing I want you guys to look at. It went from 0.47 to 0.27. We can see that the total comprehensive profit was relatively the same, around 223. But why did the earnings per share, basically the amount of money you are earning per every share, one share that's of the company that you own, why did it go down by almost half, from 0.47 to 0.27? That's basically dilution. The company is issuing more shares. They are adding way more new shares. So now you are competing with more shareholders for the same profits or even the less profit that the company is making. So if you're a bank investor, last year they were earning you 0.47 for every share you had. Now they are earning you half of that, 0.27. And in the same period, we can see that personal expenditures went from 165 to 200 million. So they are paying their workers way more. They are paying the executives way more. But with the shareholders here, they are earning us way less. You see the trend here? My main thing is that you always reward performance with higher salaries. If they are doing their job right, they are earning you more money, why not pay them all the money in the world? You are increasing the amount of money you are giving to the employees, but the amount of return shareholders are getting is being diluted. I don't like that trend. Looking at the balance sheet, we have the cash and cash equivalents going down massively from 3.9 to 2.7. Investments in securities went up 4 to 5 billion. Loans went down massively from 2.5 to 1.2. So it's either they wrote off or cleared off some of the loans or people are paying back. We'll have to see when we go into details into the reports. Overall, the total assets went from 12 to 10. Not a good thing to be seeing. Assets going down. Liabilities also went down as a result from 12 to 10. But I would say that the equity actually went up from 200 to 49. But still, overall, not something impressive. When we go into the cash flow statement, one key thing I want to show you guys here is deposits from customers. We can see last year was 2.9 billion. So basically, there were about 2.9 billion from customers that was deposited into the company. But this year is negative 742 million. So basically, this year there's not really any new deposits that's coming into, but there's more people who are withdrawing money. About 742 million of cash went out of the company in deposits, which is not a good thing to see. It means deposits is dropping. Non-performing loan went from 41 to 26.5%. So it has improved, which is very good to see. Still bad in terms of 26.5%. And also, when you go deep into the report, you can see that the main reason for that is because of write-off. They did a lot of write-off. Yes, some people did pay. We did see some of the people who had defaulted previously paying back some of the money, but it also a lot of write-offs, and also the company reducing its loan size. You can see that the company is not really giving out more loans compared to what they were doing previously. So a factor of all of this has helped with the non-performing loan coming from 41 to 26%. Can still improve it massively, but still I don't even like how the improvement is being done. It's not really more people paying back the loans, but it's more of the bad loans being written off, and the company itself is not giving out more loans. Capital adequacy ratio is still negative, showing how unsound or how weak the business is. Liquidity ratio 69, now 73, so a little bit better. And we can see this message is still here. The letter of the Bank of Ghana to us indicated that penalties associated with breaches in capital adequacy ratio, single obligor limits, and the aggregate forex open position will be computed and deferred until the bank makes profits and its financial soundness indicators are within the regulatory limits. As of 30th September 2025, the bank was not in a position to quantify the potential penalties. So they are still saying that the company is not profitable as of yet, and they are not in a financial position to receive the penalties or the punishment that Bank of Ghana needs to give them, because they have breached the capital adequacy ratio, the single obligor limits. The same thing with GCB, where you lend more than 25% to a single individual or group of connected individuals, and also aggregate forex open position as well. So overall to we can see that I'm pretty still not impressed with the performance. Still, they did improve in some areas, like maybe NPL ratio. The reason behind how they improved still not good, and the company is still not making profit. Weak structurally, a lot of massive debts they still need to clear, and the company is even refusing to give out loans at this point in time. Very bad to see. The company is now trading at 0.5 and 0.8. We can see that over the past week there's been a massive downtrend in the company. It went to like 0.9, now 0.8. And one thing I don't even understand about this, it shows how high of a liquidity we have in the Ghana market. The company started the year at 0.3, went to 0.8, but it went down massively to 0.5. And during this period, nothing about the company had changed. When the company was at 0.5, it started rising massively to 0.9. And all during this period, nothing about the company had changed. The company was still weak structurally. The company had not even released the earnings report yet, so there was no even insights into the company to say, oh, things are improving. But because right now we are in a very bullish market, there's a lot of liquidity on hand. A lot of Ghanaians started demanding all sorts of company, not just Cowbank. Even CPC went up as well. And we can see that it's not even just from the retailer side, but also the institutional investors, because there's a lot of liquidity. So, where there's a lot of liquidity, demand for even companies that are not really performing as well, you could see that going up. But, now that the report has come and, they've seen that the situation is still relatively the same, the price has gone down. And it's not just that, also dilution. This dilution was always there. We always knew about this, and the company has brought out a circular as to how the rights issue is going to happen. I think they want to raise about 900 million. For every one share that you own, you can in a ratio of what, one new share for every 0.36 ordinary shares you hold, you can buy you can get any additional one share as well. So another form of dilution, which means Cowbank investors, you go very well. I've not really gone through this report yet, so I can't give you details as to how everything is going to work. I've not had the time to do that, but I'll probably go through the whole report, and when I'm done with that, I'll probably come back and give you the full details of how everything is going to work out. I think it's going to be very similar to as to the previous one as well, but Charlie, at the end of the day, not really impressed with the company. I don't really see how things are going to be changing, but Charlie, ebeche. Until then, Charlie, dilutions. So that's my thoughts on this particular company, and it's not quite good, but like I always say, comment down below what you think. I would really love to know what your thoughts are on this particular company, on the dilution that they want to do, the rights issue, on their earnings per share going from 0.4 to now 0.2, literally half. I would really love to know what the overall thoughts are on this company. Are you bullish? Are you buying? Are you selling? Let me know down in the comments. Subscribe, like the video, share to people you think might be interested. I really appreciate it. Until we meet again, have a lovely and blessed rest of your day. And to Cowbank investors, this video is for you.
Fear, I pour you spit. I pour spit for your face. Because if I not pour spit for your face today, tomorrow you go still pour me spit. You know understand?